Okay, I think we had a good opening first class, just an introduction to the concept of individual income taxation, a form of taxation that governments often use. We touched upon the fact that there are other ways governments collect tax. We didn't get too involved in the political science of governments and how much they should spend and how they should spend their money, but we did mention the fact that that's why an income tax exists. We talked about the fact that Ben Franklin mentioned a concept of maybe 10% should be a fair amount of tax to pay on one's income. And that number, 10%, wasn't just something he made up. It went back to biblical days and what many people refer to as the Old Testament. There's a concept using an Old English word known as tithing, giving tithes, and that equates to 10% of one's agricultural produce being the income that they generated through the land that they tilled, the soil that they harvested, and giving 10% of that to the priestly class who were probably running a form of government for people back in the ancient times of the Old Testament. So the 10% was not just out of a whim, has historical precedence. Where we are today, of course, is that income tax percentages, we will see, and we did see, that there are rates of income tax, and when we get together Wednesday, we'll actually start going through what it means to have rates of income tax, whether they go up as income goes up or goes down as income goes down, and talk about the other possibility that perhaps they're just stable rates that they apply across all amounts of income. We'll also talk about different ways that tax practitioners look at income tax planning and how it relates to the rates of income tax. So that's all to come on Wednesday. The other thing that I wanted to point out in as a result of today's class is the fact that the theory of taxation is a fascinating one. The theory of taxation talks about how to tax, what to tax, how much the tax should be, and history will show that there are various theories on how that should come about. We won't spend too much time in class going over this, but to the extent that the textbook mentions it in Chapter 1, I call your attention to just understanding that area from a theoretical, academic standpoint. In the concept of the theory of taxation, one begins to see that, like we learned today, that governments have reasons for how they apply the tax. Today we talked about this doctrine, which pervades a lot of the tax code, the wherewithal to pay principle, that we should only tax when the taxpayer has the ability to pay. And what that does is it leads to certain reductions of tax based on certain situations in life, certain trigger points in one's life. And we learned it applied to children. We learned it applied to having a house where you borrowed and you have mortgage interest. And the point this brought about is that even if the theory of the taxation of allowing for a deduction of children and for mortgage interest relates to the wherewithal to pay principle and is a good theory, I think a strong argument could be made that this makes sense. This is fair. And that's an important point to bring up, that this is a fair way to tax, to allow for these kinds of deductions so that people are not harmed by life's events that may otherwise cause them to be poorer for it, because they're being taxed at the full rate while also incurring the cost of raising children and in a household. But people, being people, human nature, and this is the part that I think we touched upon, but I wanted to make a little bit certain that we didn't miss this. People being people, there is a tendency of human beings to want to pay as lowest tax as possible. We might want to call it tax avoidance. We don't mean something illegal, but we certainly mean that people would like to lower their tax, and thus when the tax law goes a certain way, it may cause, arguably, people to adopt life practices, to help lower the tax, which would be having more children or buying a bigger house with more mortgage interest. These factors lead to, perhaps, we should say, lead to unforeseen consequences where people do exactly what I just described. They have children, they get married, they buy a house where there'll be a huge mortgage, and it affects the social dynamics of a country and the economic dynamics of a country. The social dynamics meaning people are encouraged, or they think they're encouraged to have children. The economic dynamics, people are encouraged to buy big houses with big mortgages. And there are hosts and hosts of tax laws that have consequences like this, and what we call these consequences are the social economic consequences of the tax law, all in the interest of lowering one's taxes. It's a human nature thing. I just want to make sure you follow this part of it, that people would like to reduce the amount of taxes they pay ultimately, and they may do it by looking at the tax law and saying, okay, well, let's adjust our lives to behave in a way that will wind up in lower taxes. And on that note, we'll say see you Wednesday. Thank you.